Hello and welcome to the look ahead for Thursday, the 6th of February, with me, Fiona Cincotta, Senior Market Analyst at City Index. So just taking a look here at what we'll be watching tomorrow. We've got German factory orders. We also have European retail sales. Key focus as well tomorrow is the Bank of England interest rate decision. Also have in the US session, challenger job cuts as well as jobless claims. And then earnings will be very much in focus with the release of Amazon after the US close. So just to start with what we'll be expecting from the Bank of England. So the Bank of England is expected to cut interest rates by 25 basis points. This will mark the third rate cut that we've seen from the central bank in this easing cycle, taking rates from 4.75% to 4.5%. Now, the meeting comes as inflation in the UK cooled by more than expected to 2.5%. We also saw a cooling of service sector inflation, considerably more than expected, to 4.4%, down from around 5%. Now, service sector inflation is an area that the Bank of England has been watching very closely. Sticky service sector inflation, which is intrinsically linked to high wage growth, has been an obstacle for cutting interest rates as far as the central bank has been concerned. So the fact that we've seen that starting to cool will be an encouraging sign. In the last meeting in December, we saw 3 policymakers vote for a rate cut. We didn't cut rates. The Bank of England didn't cut rates in that meeting, so there were 6 who voted not to. In this meeting, we're expecting possibly a 7-2 or even an 8-1 vote in favour of cutting interest rates. Also, we'll have the projections from the Bank of England. So we'll be looking to see what their outlook is for the inflation, for growth, and for the labour market. I think obviously the inflation outlook is going to be key here for deciding or for the market to ascertain really how many more times the Bank of England may be looking to cut interest rates over the coming year. Now, this we'll be looking here at the Bank of England, the sterling US dollar cable chart. As we can see, the pound has actually recovered from the low that we were hit here back in the beginning of January, down at the 121 level. Done a really solid recovery, rising above that falling trend line, and also taking out what we're just taking out at the moment, that 50 SMA. That 125 level was pretty key in the sense that we've got the 50 SMA there. It's also the psychological level at 125. Now, if we see continued strength in the pound, then that could mean that we get 126 hit. That would be under the expectations that perhaps we hear of a slightly less dovish Bank of England. But I think actually they're maybe seeing the we might see a more dovish sounding Bank of England, particularly when we think about the outlook as far as growth is concerned in the UK, which has stalled, and also as far as jobs is concerned. We had the October budget from Labour, and they have they will be increasing the tax burden on companies as from April. So we're starting to see a slowdown in the jobs market, job cuts, slow down hiring plans, which is something that the Bank of England will be looking at as well. So I think, tomorrow I'll be watching the projections for inflation and also the outlook for the labour market as key indicators as to what the Bank of England will be doing. But if we do hear from the Bank of England a slightly more dovish stance, then that could bring the pound under pressure. On the downside, obviously, I said that 125 level is pretty key. Below that, we'll sort of be looking here. This is this falling trend line that dates back to 2007. That offers support around the 123.60 level. And that's also near the falling trend line support from the upper channel. And then if we get a break below here, watching out for 123 as the next level on the downside. That was the April low. If we get below there, then potentially that could bring the 121 level back into play. But again, this has a lot to do with what's going on in the US dollar. We have seen a weakening in the US dollar as sort of, the market becomes a little bit more relaxed about what sort of trade war risks are. We're seeing a receding in those trade war risks, and that's just meaning that the risk premium on the US dollar is fading, and we're sort of seeing those safe haven flows move out of the greenback. So obviously we've seen that US dollar weaken, which has provided support to the cable position. As I said, we've got data tomorrow from the US as well. We've got jobless claims and the challenger cuts. These come after we saw a mixed picture from the US as far as data is concerned. We've had the ADP payroll came in stronger than expected today. We saw JOLTS jobs openings come in weaker than expected yesterday. And then we've got the non-farm payroll on Friday. So obviously movement in the dollar could be driving this pair as well. Just whilst we're talking about the UK though and the Bank of England, let's just take a look at what's going on with the FTSE. As we can see, the FTSE was trading within this relatively familiar range for much of the past 9 months, broken out more recently here, and we're seeing it sort of powered up to that all-time high of near the 8,700 level. Did fall back, but we're actually staying within a relatively familiar zone. That pullback just pulled the RSI out of overbought territory. We're back above this level here, which is the 85 level. So buyers are going to be looking for a move towards that 87 level. If we hear from the Bank of England a slightly more dovish tone, then that could be beneficial to the FTSE. Obviously, the FTSE is a majorly international index, but if we get a sort of weakening in the pound, then that could help push the index higher, thanks to a more favorable exchange rate for those multinationals. Obviously, domestic stocks as well, they will be boosted by expectations and optimism surrounding more Bank of England rate cuts to come. Now, the other thing to be watching out for is we have the earnings from Amazon tomorrow after the close. Now, the pressure is very much on Amazon. If we think about sort of, where it's been trading, the lofty valuations that we've had from Amazon and the expectations for its cloud computing in Q4 results, this comes after Microsoft and Apple disappointed with their lackluster performance. So Amazon could actually be positioned to capitalize on this cheaper AI. Obviously, let's not forget that we heard from DeepSeek just around 10 days ago regarding the an unveiling of a potentially cheaper AI model, a more efficient AI model. So that's really raised lots of questions about spending on AI from these big tech. We saw Alphabet fall 7% on the opened day, with the market questioning its huge AI spend. But as I said, Amazon could be better positioned to capitalize on this cheaper AI. The Amazon Web Services are expected to bring their strongest or post their strongest revenue growth performance in 8 quarters at 19.3%. So there's quite a lot of pressure on them. I mean, if we just actually have a look at the share price, it's trading pretty much around its all-time highs. If I just go out to the weekly chart, we can see it's trading within this rising channel that it's been trading in. It's towards the upside of that rising channel, trading pretty much the all-time high around the 240 level. But we are just potentially seeing the RSI in a little bit of overbought territory, so we may see some consolidation. But a break above that 240 level, we could see fresh all-time highs towards 250 and on to 300. But as far as let's just have a look at what this means for the S&P 500. Let me just bring it back to the day. We can see the S&P 500 has actually held up pretty well, given the volatility that's been shaking the markets over the last 2 weeks. We can see here it's still holding above that 50 SMA. It's still above the 6,000, just around that 6,000 level, which is obviously a key psychological level. We're seeing an upward pointing RSI, which could potentially mean that momentum is to the upside. But these long lower wicks on the downside suggest that there was little selling pressure at those lower levels, which should be encouraging for bulls. But we're just at this sort of wait and see mode at the moment. But buyers are going to need to Say hold above the 50 SMA, look towards that 61.20 level. On the downside, if we're going to break below the 50 SMA, then that's going to be bringing 59.15 back into focus. That's the 100 SMA. It's also the lows that we saw this week and also last week when we saw the shakeout from DeepSeek and also from the tariff announcement. Trade tariffs, as I said, very much been in focus again this week. We've been a lot of toing and froing. Will they, won't they? How much? Too middle. China do have trade tariffs. They've retaliated. They haven't retaliated too strongly, which has helped sort of calm fears about a trade war. And we've seen the pause for Canada and for Mexico, which is helping the mood as well. So, but any developments as far as trade is concerned could also potentially drive these prices. If we're getting, we see any weakness in the jobless claims, and then we could find that would be beneficial to equities. That could help support the case for further Fed rate cuts. Stronger data may have the opposite effect. So that is everything that I will be watching over the next day. I hope you've enjoyed this, and I look forward to seeing you tomorrow.